Welcome to episode 15 of Kontrarian Korner. I'm Ben Kelleran. Today we have Vince Lanci on to talk about everything commodities. We'll be focusing a little bit on oil, coal, platinum, anything else he wants to talk about. But Vince, thanks for coming on.
Thanks for having me on. Good to be here, Ben.
So I was listening to your chat on Palisades Gold Radio the other day. Kind of lined me up with several different questions, but wanted to kind of get your thoughts on oil markets broadly and kind of what you see going forward over the next 3 to 5 years, because I think the setup looks pretty interesting with some of the stuff I've seen in the Permian, some of the stuff with supply and demand statistics maybe being a little bit cooked, but I'd be curious to hear your thoughts on that.
Okay, so oil. Just starting with what we know publicly, demand is going to be going up over time. There's going to be a waning effect of climate risk. And so hydrocarbons are going to be more in fashion. We were talking about coal before we got started recording here, and that's an example one. The problem with oil is well, even if we go back to oil, we never went off oil. Even if you can't stop using oil until you have something that's more efficient. And you can do pie in the sky and idealism all you want, but nothing is as efficient and that creates as much power as oil. Now, there are two schools of thought. So demand is going to go up for oil. So I think most people think that, as do I. The only thing that would knock that down would be if we really did come up with some sort of a thorium reactor that was scalable, or nuclear, or home nuclear energy, which even if it were possible, would take years to be permitted. All right, so the supply side, the demand side, we pretty much know, right? The supply side, there's debate on that, and there are people out there that are more in tune with the fundamentals than I am lately, and one of those would be Bryn Kelly, colleague of mine, someone good to have on if you're talking oil next time, if she's around. She still trades power and oil. The fundamental, the supply side is you hear these violent in the Twitter sphere, these violent peak oil versus not peak oil, and I don't give a shit about that. I'm just looking at supply, and I do know that using the U.S. as an example, we're becoming less efficient with our shale oil production. We'll get more. We'll figure out something else to do, and I'm not being glib about it. We have access to more oil. The war on American producers is over. Like that whole Biden war between 20 and 22 and a half. That's over. Like we're drilling, whether it's Republicans saying we're drilling and bragging about it, or it's Democrats saying we're drilling and hiding it. We're going to drill more. And there's a lot of untapped oil out there. Now, so we have it if we need it. We just don't want to have to use it. The other aspect on the oil supply side is we as a country want more oil to be produced because it saves the petrodollar. So the lower the price of oil goes, it uniquely helps us because energy is cheaper. Fine, it helps China on the demand side, but it basically impoverishes, 1/3 to 2/3 of the BRICS that depend on a high price of oil to make money. That wouldn't help Russia. That wouldn't help Saudi Arabia. It wouldn't help, most of those countries over there. It would help China. So I believe it's our intention to get oil as low as possible. And I believe, ways to do that are manifesting in the market now. And they started manifesting at peak inflation. And that was when I said back then, I'll say it again now, is that at some point during the inflationary crisis, for lack of a better word, when Biden was screaming about big oil gouging prices, and then about Saudi Arabia or OPEC gouging prices, and everybody and their mother gouging prices, the reality is we started selling oil into the market at a more aggressive way. So the phrase that I used back then was, oil is the new gold. And that is, if you want to keep the lid on the price of oil for all the reasons I described. One of the ways to do that is to tap the SPR, right, more than you should, but still within the confines of what's permittable, I guess. Cut quiet deals with oil companies, which they did. Establish friendly relations for trade in local governments for natural resources like Argentina. We're doing that with natural gas there, and we'll do that with lithium as well. And finally, what's the word that we used?
Unnatural.
Unnatural. I can't make that a verb. We observe that in the oil market, price behavior has become very suspicious. Unnatural is the word that you used, and all that really is the oil market being capped in the process of how they operate things to keep the worry of inflation down. And the reason that's so important for America is it's easy. See, American governments in general, and America in particular, they do this. They like to find a point to break. Like they want to put their finger on one point and have it broadcast. So if you keep the price of oil down, you affect the price of the one or two things that people see frequent price changes in constantly. And that is, in the summertime, it's gasoline. You see a reminder of inflation every time you fill your car. That's a big deal, right? The other is heating oil, right? Or electricity in general, for if you do use electric heat, or forced air, however you look at it. So if you can squash inflation at the energy level, you affect so many things. And it's the most efficient way. It's how centralized finance or centralized government works. They like to put their finger on one thing and push it down. So long story short, I think depending on the president, right? And I'll explain the differences. Depending on the president, the price of oil will go up fast or go up slow. Okay, so for example, I'll give you, like, let's say Trump, and we'll use Biden because Kamala is, I think, an unknown quantity. Trump, looking at American politics, Trump is all about getting inflation out of the headline and not worrying about unemployment. That's Republican. Okay. Biden is all about getting unemployment out of the headline and letting inflation float. So that ties into that whole three-stool thing. But politically, the effect on oil is this. If Trump were to win, right, we're looking at oil for the next 4 years, right, which you basically said 3 to 5 years, right? Mm-hmm. If Trump were to win, his policies would be bearish for oil. I'm not saying it'll make oil go down. They'd be bearish for oil and bullish for oil companies. You'll be able to drill more. We'll do tax breaks or tax subsidies, and there'll be reasons to own oil companies beyond oil. So you'll be able to drill for lithium, which is what they're doing in Arkansas now. I think that's Exxon. So a Republican's going to say, I want low inflation, and I don't care if people get fired. And that Republican will do that by saying, all right, no more fiscal spending, I'll cut deals with companies, and we'll lower interest rates. So oil goes up at a slower pace under a Republican than a Democrat. The thing about the Democrat side is the Biden style is he wants high employment and doesn't care about inflation. He'll let inflation go up, but then he'll do things to jaw it down, or Democrats in general. So the Biden, we'll include Kamala in this, or Kamala, I'm not sure how to say her name. That combination is a 70s style Democrat. They're not neoliberal. They are, to use the phrase, tax and spend, right? So we're going to spend more money to help people out that are poor, ostensibly, right? And we're going to tax the rich to do that. And that's a simplified way to look at it. There's a lot of nuance to it, but that's what they did in the 70s. And the spending in the 70s was on the social safety net. The spending now is on climate stuff, windmills, and which is, it's just the zeitgeist is just so annoying. The funny thing is, in 5 years, we'll probably be spending money on social safety nets again if AI is properly used going forward. So that's
retiring those windmills.
Exactly. Right, exactly. Windmills. Yeah, I mean it's an ideological nightmare. People are just dumber now, and as a result of that, politicians can be just a little bit smarter than them and to get their policies across. But to answer your question about oil in the next 3 to 5 years, up over the next 3 to 5 years, faster under a Democrat, more volatile under a Democrat than under a Republican. Demand's not going to go down. Demand's going to go up unless we come up with some, again, portable nuclear reactor. We want, as a country, we want the price of oil lower. If we get the price of oil lower, it saves the dollar more. So we're going to keep a lid on the price of oil as it goes higher. People forget, oil's trading the same price it was years ago. I mean, we have it so lucky. Oil is just way too cheap if you want to look at it as an inflationary tool. The problem in the United States, and this is a big problem, I talked about this on Palisades. This is also how stupid some politicians are. They're selling oil to get the price of gasoline down. But because of climate agenda, because of environmental agenda in general, we've limited refineries. You can't open new refineries. You have to get special permission to add to refineries. And as a result of that, oil can go to the price of zero, to exaggerate. But gasoline will still be $5 a gallon. Now, why is that? Well, because we don't have refineries that can handle. We don't have new refineries. We need refineries to make it, and Europe's constantly having a problem. So we're constantly now shipping our diesel over to Europe for profits, and as a result, the inflation is staying here a little bit. We're giving them a little alleviation. Anyway, I hope that helps a little bit on oil in general. But oil's being, to use the word, oil's being manipulated. Oil's being kept in a range. Oil is the new gold.
Yeah, I think when you're talking about politicians, kind of the phrase that came up in my head was the in the land of the blind, the one-eyed man is king.
Oh, yeah.
I mean, it's frustrating to watch our politicians, like you said. But if I could just pull on a couple threads there on oil, I think that'd be interesting, just as far as kind of the price being capped. Do you think that's something that starts to come off after the election, or do you think it's just gradually going to kind of float higher, where it's up 10, down 5, kind of chops around, but we're basically heading towards 100 over the next couple of years? Or what do you kind of see as far as that?
I think most of the people that will, pose as experts will say it's going to $100 in 5 years. They were probably saying that 5 years ago. Like, oil really is in a range, so I don't want to just make stuff up. But to answer your question, if you're looking at the short to intermediate term, whatever's happening now will stop happening after the election. So if oil is being kept in its place a little bit, yes. If OPEC, specifically Saudi Arabia is being asked to play nice while all this is going on, and they are, to the extent that they are playing nice, they'll stop playing nice when the election is over. The Fed's going to go into an easing cycle. Allegedly, I think they will. I just don't know it will be what everyone does think it'll be. And look, if Biden wins, he's going. I'm not Biden. If Kamala wins, look, no matter who wins, you're going to have a split Congress. I think. I don't think you'll have Trump sweeping. I don't think you'll have Kamala sweeping. If they do, if either side sweeps, how's this for a signpost? if Trump wins and brings in a Republican Congress, then oil is going to go higher in the short term, because if you have that kind of mandate, you tend to spend in your first term, your first quarter, right? If they're split, then nothing gets done. So can you imagine all these promises that Kamala has made recently, about subsidizing and helping people that may need some help, call it
Price
rent control.
caps and all that. Yeah.
Yeah, exactly. Raise caps, right? Exactly. Like, tactics as strategy. Can you imagine if she won and the Democrats came in owning Congress? That would be, in their mind, a mandate. And so she would try to push something through. That's going to be more spending, right? If Trump wins, and he gets a mandate, he's going to spend as well. He's going to spend on different things. But even if he doesn't spend as much, he's going to lower rates. So I think oil should go up in the first quarter of next year. But in terms of the march to 100, unfortunately, it really depends beyond the fundamentals, which matter less and less now. It's pretty scary. The geopolitics between us and the BRICS is going to matter more and more. So I guess the answer is we should have a boost out of the gate in the first quarter of next year. And then after that, volatile and higher. I'm not going to pick a price, though.
Okay. Yeah, I think I agree that it'll be volatile. It's kind of frustrating to watch, though. But do you have any insight on kind of the influence of paper barrels being traded versus the physical markets? Because I think that's I've heard different figures, but I've heard anywhere from 50 to 60 times. Like the paper markets is way bigger than the physical. I don't know if you have any insight on that or any thoughts on how that influences things.
Yeah, I haven't been studying the recent data, but between 21 and 23, I was very intensely involved in it and studying it and doing some oil work with Bryn, the woman I mentioned before. And all right, just to the analogy is to gold, right? And I'm not speaking from a gold perspective. The analogy is this. If you don't have to take or make delivery of the commodity, you can trade as much as you want. Hence rehypothecation. So the ratio of paper barrels to actual barrels has definitely gone up over the last 3 years. And here's the insight from a veteran trader. The funds that used to be always bullish and always profitable because they could stomach the $2 drop for the $5 rally, they're shrinking. The footprint of hedge funds playing the oil futures market is shrinking. And the directional guys, there's all other kinds of guys, arbitrage and spreaders and what have you. It's shrinking. The CTAs, which are the commodity trading advisors, which if your audience isn't familiar, they're basically tiny hedge funds that are comprised of doctors and lawyers and retail money, and they kind of chase trends. Those guys are moving the oil market disproportionately to what they used to. Now, what does that tell me? Well, when your big hedge funds are no longer playing, bull or bear side, but mostly bull side, number one. Number two, when your CTAs or smaller guys are moving the market more than they should, they're introducing more volatility than they should. And when your paper to physical ratio is increasing the way it has been, well, you're looking at a market that's breaking. The market is breaking. The futures market is breaking. It's becoming, in extreme, it's palladium. In its extreme, it's silver. In its extreme, it's, lean hogs, meaning it's referenced for price, but nobody trades it anymore. Now, there's good reason for that fundamentally. There's very good reason for that because the center of oil was in the U.S. Now it's in Brent in the UK, and eventually it'll move even further east, probably towards maybe Nigerian.
Dubai, I would guess, maybe. No.
No, no. The quality, the standard.
Got it.
It's they want the sweet standard, even though they use an index or a mix. They'll index to the most popular sweet oil. So it used to be WTI, now it's Brent, and eventually it'll become Nigerian sweet, something like that. But the volume, the Dubai oil is obviously as important, if not more important, but they benchmark to that. So the WTI contract is getting killed in terms of importance, right? The epicenter of oil is moving east. Okay, so the UK is the focal right now, number one. Number two, the US is definitely cooking the books on oil price. And I'll give you another example of that that I don't think anyone else knows except for maybe Bryn and me and a couple others that we discovered. But before I do that, so you've got the epicenter of let's put it this way: the demand has moved east, and so the benchmark moves east. We don't want to have WTI go all the way to China. We'll have Brent and whatever's in that basket go to China, and we'll mix it in China with Dubai sour or whatever. Right? There's that. You have a U.S. that wants oil to be weaker, is producing more of its own oil, and so you're seeing a decoupling of WTI from Brent even more than there had been in the past. So WTI is becoming a little bit, I'm getting ahead of myself here, but WTI is becoming an orphaned contract. Now, the other reason it's orphaned is because geopolitically the world is split now, right? I use the phrase mercantilism a lot. The more common words are deglobalization or supply chains breaking. And that means commodities that were global are now regional, right? China's not going to buy WTI. We're not going to buy, someone's copper. They're not going to let us buy. Lithium's an easier example to understand. So global commodities traded globally, benchmarked to the U.S., are now more regional. We're seeing that in gold as well. They're actually seeing big price disparities there. Meanwhile, commodities like natural gas, which are regional commodities, are becoming global because they're more liquid. But back to oil. Here's another thing. I know as much as a person can know that the U.S. senses that WTI's importance as a contract is dropping, because when OPEC started raising prices or reducing supply, the benchmark is a basket, right? It's a Platts basket that all deals are priced to. And the basket is, let's say, I'll make a number up, 40% Brent, 15% WTI, 20%. And they have this mix, and it's a basket. When the Saudis and OPEC cut production, raising price, the U.S. on the QT, it's public, but you have to look for it. The U.S. got the basket that's accepted globally worldwide to take more WTI in the basket. So as our importance as a physical commodity drops, our importance as a basket in the index increases. So we're cooking the books any way we can to keep the price of WTI relevant, because that's a stronghold of the dollar. The lower oil goes, the lower oil is, the stronger the dollar is. The lower the dollar is, the higher oil is. So those two things work together. But that's basically it. WTI as a trade is less important. There's one other thing in terms of the fundamentals. If you have future traders who watch this, you cannot, if you're not going to make delivery and you're just trading paper, you have to keep rolling. And so evidence of rolling or failed paper manipulation is when the backwardation starts to steepen. Okay, because when the backwardation steepens, and this will apply to platinum too, we're going to talk about that later on, I think you want. As the backwardation steepens, it creates a dividend. So if I'm long at $50 in oil for 2 years and it goes to 70, and now the front month that's expiring is 70 and the second month is 69, I make $1 by rolling. I lower my cost basis every time. Meanwhile, it's a negative carry, right? Meanwhile, those people playing from the short side are having a bigger and bigger tax. And so you'll eventually see the backwardation from front to back in futures steepen even more. We're not there yet, but you see it in gasoline. Oil could be dropping $10 and the gasoline curve is front month to back month still like this because nobody has physical. Everybody has futures, but everybody needs it now. So that's it. American oil prices declining in importance. That's it.
Yeah. Do you have one of the things I think is interesting to look at with some of the production stuff in the Permian? I've seen a couple people make a pretty compelling case that we could be in the beginning stages of a kind of rollover in production in the Permian, and that's has pretty broad implications for worldwide oil markets. I don't know if you have any thoughts on that, but I've been looking at some of the stuff from, I think it's HFI Research and a couple other people that follow it very closely. So I'd be curious if you've done any digging there.
I have not, and I haven't been I used to pay close attention to that back in when the natural gas fracking started and the shale oil started. I was very focused on that in terms of trying to predict future price. But I got to be honest with you. I mean, I'd be interested in more in what you have to say. I'm not really sure who's right. So Permian's running dry. Fine. I've looked at a couple charts, and the production coming out of the wells, is peaking a lot earlier, and that's a decline. The question about that, though, is we've had these problems in the past, and I'm not being arrogant and saying technology will just solve everything, but I am saying we had this problem before, and then an innovation comes up, like in 2008 when China came on the market and said, we're buying oil, and oil just went to 146. And then magically we came up with, the Permian Basin. We came up with, horizontal drilling. And I was like, it's when there's enough money in it, we figure it out. But I'm more interested in hearing what you've heard about that.
Yeah. So I think there's a couple things where, like you said, there's the decline rates that I think is probably going to be an issue. The production's getting gassier to the point where you're seeing negative natural gas prices at some of these hubs. And like the way I kind of look at it is like, I don't know when, but I would be surprised if we get to like the end of 25 or the end of 26 and we're still talking about the Permian production growing. And I think when, but if it does roll over, just due to the nature of shale, it's going to roll over quickly because of the decline rates and some of the stuff there. So
right, the hockey stick concept.
Yeah. And so that kind of gets into, well, like, where do we go? And that kind of leads into the offshore thesis a bit, but also like things like Alaska and people talking about like I don't think we're at peak oil or anything like that, but I don't think the lifting costs for like going out and finding some of these new sources of oil is going to be, oh yeah, break evens are at 30 or $40 a barrel. And it's just happy days again. Right. So that's kind of the general view there. But I think the setup for some of the equities have been out of favor, basically been slaughtered over the last 10 years, call it. And just starting to show signs of life are pretty interesting. So,
right. Yeah. All right. So before we do the equities, there's really not much I disagree with. And here's what I mean. I'm under the assumption that Permian is drying up. I don't think that's debatable. Aside from some novel technology or some new kind of 4-dimensional drilling, Permian's drying up. Okay. I'm assuming that. I believe the remaining smart people in government or in the energy industry also know that. If I'm talking about it, they've already planned for it. And I believe that subsidies are well underway to give oil companies deals to drill for more, right? So to the other point that they made. So are we going to offset the drawdown in Permian supply over the next 5 years? Yes. Will it be at the price that we got Permian? No. And that's why I think oil marches higher. The cost base is going to increase. So forget about the whole pie in the sky about 4-dimensional drilling or technology innovation. the oil's out there. We just are going to have to pay more for it.
Yeah.
But here's the thing: the U.S. compared to other countries, I remember when they started when the oil when the shale oil was tapped. They're like, oh, it's not profitable until oil's above 50, and then oil went to 50. It's like it's a magnet. So we will have the supply at a price, and I believe the price will go up. And I believe the drawdown in Permian will be mirrored with an upswing in price, and it will approach whatever the price is that we have to pay to get the next batch of oil out of the ground, unless, of course, we decide to just drill a hole in Alaska and get the rest of that oil out, or invade Venezuela. Always possible.
Yeah. That kind of brings me back to one of the things I think is interesting too, but I don't have much of an opinion on it, which is like the OPEC spare capacity. I know some people look at all the production cuts they've been doing and say, oh, that's just going to come right back on the market. And that's kind of another reason the oil price is capped. But there's others that kind of look at it and say, they might say they have, 2 or 3 million barrels or whatever. But
Right.
A lot of people will say, yeah, they don't have that ammo to bring back online. But I don't know if you have any thoughts there.
No, I mean, I don't know. I've heard the argument both ways, but I haven't seen a lot of data on it. But the argument restated is they're cutting back because they don't really have much more, and they don't want to let people know. Yeah. And the other argument is, they have plenty. I don't have any familiarity with it at all, except to say in the past, especially approaching wars, if we called them up, the Saudis, not OPEC in general, but the Saudis, and we said we need more oil for the next 6 weeks, they pressed a button and that oil became available. So it's really a matter of, if they're running out of oil, maybe they're running out of oil 5 to 10 years from now. I mean, all their oil is very close to the surface, right? They have cheap oil, very cheap oil. Am I right about that?
Yeah, I think I've seen, and this is probably old, where it might not be up to date, but I think someone was saying it was like $10 or $15 for Gawar there in Saudi Arabia.
No. All right, you'll enjoy this. All right, there was a time. Your number is right. That is an old number. I don't know what the new number is, but there was a time in '99, and I was trading oil, and I didn't understand what was going on. But an oil analyst understood. I was trading options. An oil analyst explained it to me, and oil just crapped out, right? And it went to like $11, and then it stopped and then reversed and just started going higher for a long time. And I said, "What happened?" Because I didn't know the fundamentals at the time. The guy said to me, I mean, it's almost like a joke. He said, the Saudis were not getting along with Iran, and they said, we see that you're cheating. The whole allocation, you're not giving us enough percentage to pump, so we're cheating. And the Saudis were like, we see that you're cheating. We don't like it. And if you keep cheating, we're going to pump so much oil so fast, you won't be able to pump fast enough. And the story was the Saudi Arabian, Aramco, right, which is basically American tech back in the day. They just pressed a button and they said, "What's oil cost us? $11." They pressed a button. They said, "Keep pumping oil until the price is at $11." And that's literally what happened. Meanwhile, the Iranians at the time, the description was they had a rig with 3 donkeys circling it, and they just put another donkey on it to get a little more oil out. And so the Saudis just pressed a button and shut them all down, and all the other OPEC members complied, and then it went up. So the price isn't 11 anymore, but it certainly is cheap now. Now Russia is also a very low cost producer, and there are people like Tom Luongo who say that Russia may be an even lower cost producer than Saudis. Now I don't push back on much with Tom, but I think that Saudi Arabia is the lowest cost producer. That oil is it's like right under the surface. It's like a scene out of the Beverly Hillbillies where the guy shoots the ground and the oil comes bubbling up. So I think there's probably a ton more oil in Saudi Arabia that's going to have to be drilled at a higher price. That's what I think.
No, that's the story is a little bit a Saudi and a Persian walked into a bar type deal, but that's definitely interesting to think about. But
If you
one of
pull a
the
chart up, you'll see that it's like oil. I think it was in '99 when because I was trading gold and oil options at the same time on the floor,
mhm.
and I was making money in gold and I was happy. And I said, "Oh, look at oil. It's it's trading $12. Why is that?" So that was like, why? What happened there? Oil used to be a notoriously efficient market. Once upon a time, I'm being the old man here. Once upon a time, a Texas senator said when oil was trading, I don't know, $18, he said, we're going to reduce our dependency on foreign oil. We're going to tax all foreign oil $5 up to $23.
Mhm.
And so that way domestic oil will be cheaper. Well, the price of oil went from $18 to $23 in like 5 days because of that, because the oil market is so efficient. Now, the reason I bring that up is because it's not efficient anymore. It's becoming a broken market, which might be
It's
symptomatic
political.
of
Yeah.
which might be symptomatic of the of the uh, of the services industry too. I wouldn't know what to make of those companies anymore. I don't know what you should be buying.
Yeah.
That's something that you have.
The thing that's interesting there is I've heard people make compelling cases for the onshore drillers and some of the onshore services companies, but I kind of just put them in the too hard pile for now because, like with the offshore drillers, they basically all got blown out after 2014. With, I think you had like a ton of new builds hitting the water. You had oil going down to $30 in 2014. All this different
Right.
stuff, and so I think there are only a couple companies that made it through without going bankrupt. But that reorg for a lot of them basically set them up for a massive run off the bottom in 2020, 2021. And now they're still trading at what I would guess is 25 to maybe 40% replacement cost, depending on which company you look at. And like, just take a big drill ship, for example. Like, the estimated cost for a new one is $1 billion, and it's going to
Mhm.
take you 4 or 5 years to build one.
Right.
And that's before you get into inflation and shipyard availability and all these different factors. And like, some of these fleets have 30 or 35 drill ships, and you look at kind of enterprise value, all that stuff, it's like 10 billion or something like that. So
Right.
it's and that's what day rates for rigs going from 200,000 to 500,000, touching 650 on some of the highest quality rigs now, at least out a couple of years. But um it's going to take some time, but there's stuff in there that I think has a very asymmetric setup if your kind of time horizon is, call it 3, 4, 5 years. So there's stuff that'll go quicker because of the shorter contracts, like the service boats and jackups. But
Right.
um, I just basically, when I try and compare the offshore sector to something like a Neighbors or something like that, that is an onshore driller, it's just I can't compare kind of the risk reward there and make it make sense. So I've kind of stuck with kind of the offshore space. So
So maybe the regulatory situation might be the foot that's on the neck of some of these companies too. I was talking about refiners,
mhm.
how that affects drillers as well, possibly. I don't know.
Yeah. Well, I mean, if you look at like what the day rates would have to do to start making new builds make sense, at least to make them somewhat economic for these companies, like you're looking at like 750,000, I would guess, as far as day rates. And so
Right.
when you have like the high fixed cost and you're looking at, I think it's like 150 or 200,000 a day, kind of rough ballpark for
Right.
their operating expenses. But you have revenues like that. Basically, you just see the cash flow explosion, and then you get the 4 or 5 years before you actually see new builds showing up. So it's very different from the short cycle onshore, where like I think it potentially has legs to run for. I mean, I think 2030 is a reasonable guess as far as an estimate, but it could go longer than that depending on what shipyard capacity is and all these different factors. So,
Right.
um,
Okay.
Yeah, I mean, I think it's pretty interesting. There's some stuff in there too where with the bankruptcies, there's some warrants that I think are pretty interesting, but that goes a little bit out of the risk curve. But um, maybe shifting to some of the precious metals here, I think we're kind of in the early stages of what I think is a precious metals bull market. I kind of look at it over a 3-5 year time horizon. I've avoided the miners for the most part. I do have a small position in a couple of platinum miners because I think that's a pretty interesting setup. But
Right.
maybe if you want to give some quick thoughts on gold and silver before jumping into platinum.
Well, I mean, the gold and silver story is actually it's very interesting, but we'll keep it. But it's so talked about in my world. I'm so tired of talking about it. Look, gold is now competing with U.S. Treasuries as a store of value on nation balance sheets. As a result of that, for every treasury that's sold or bought, they're buying an ounce of gold or a pound of gold or what have you. And between now and I'll just throw like a couple simple things out here. Nobody in their right mind is going to sell or get short gold between now and January 5th, let's say. And that's because the BRICS are in a position where they have a mandate from last year to buy gold. Whether they're right or wrong or they'll succeed, I don't care. They're buying gold as part of their plan. They need to have more collateral. Mm-hmm. Something Zoltan Pozsar said a couple of years ago. There will be a crisis of collateral. And there's not enough good collateral to go around. So they're buyers of gold, not necessarily at any price, right? So let's assume that they're patiently trailing it. And then you have a couple China funds that are front-running the BRICS, kind of like what U.S. funds used to do. And then in the U.S., you have the beginning of we're just at the beginning of the contentious election that's going to go down that may not be settled. I'm not being sensational here. The election may not be settled until the inauguration day. And I say that because there are early indicators, forgetting about the constitutional and all. Both sides have added more lawyers than they have in the past already. So if Trump were to win, the Democrat side would sue for tampering, right? If the Democrats were to win, if Kamala were to win, assuming that she's the nominee, then the Trump side would sue for tampering. The Democrat side would sue for constitutionality. There's different things there. You can't have a felon be the president. They'll raise some. The point is, I think we're on the road to politically being a banana republic. And as long as Trump and or Biden are involved, and Trump is still involved, you're going to have no one in their right mind who wants to get short gold. So that's the gold story. The silver story is the vaults have been depleted. They've stopped being depleted, but silver is higher, but still relatively stable. Why is that? Well, because there's a lot of above ground silver that's being sucked out of what's called concentrate. So you mine zinc, you throw some acid on it, you pull silver out of it. I'm simplifying it, but that's the idea. So they want the gold. They need the gold right now. And so between now and the end of the year, I would not be a buyer of silver if gold was going up. But if gold goes up after the new year, I'd be a buyer of silver because I have a feeling that the BRICS have something more in store for silver on the industrial side. So that's metals, right? But moving to platinum, which is a story that I've played in, you and I talked about this beforehand. I've been playing this story off and on for 4 years and have been watching it for 15 years. And that story is, platinum is just, if for those not familiar, platinum is heavily used industrially, unless it's changed, for catalytic converters. And it used to be heavily used for diesel catalytic converters. Palladium comes along and it's wonderful for gasoline engines. And so the gasoline engine gets all the palladium and people are buying gas engines and diesel's just not making it anymore. It's not clean enough. And so palladium just overtakes platinum. And now you're in this this electric vehicle thing, and that's been the reason to not own palladium. It's also, however, been the reason to own platinum somewhat, because platinum factors into EVs. Even if it doesn't factor into EVs, it factors into the batteries, it factors into electrification in general. So I've been watching, I played this before. I was long platinum and short palladium 3 times. 2 times I got my ass handed to me. One time I made money. But the reality is platinum is undervalued, right? I mean, Grant's had a lovely article about this recently. They talked about Amplats, and I shared excerpts of it with subscribers. And look, they make all the normal cases for it, but they just think that, and I think that platinum, without getting too specific, platinum is very undervalued, and it remains undervalued because people are looking at a recession coming, a global recession, and that as autos uptick, platinum will increase again. I personally look at platinum only as compared to palladium. So I'm not going to say I'm an expert in the platinum industry. I look at platinum and I say it's so much better than palladium. Palladium's crumbly, it's light, it falls apart. It's only good for one thing. Why is it even competing with platinum in price? So I'm a fan of platinum, but it's so industrial, and it's so, the marketplace is so fickle on it that I don't know what to do. Again, that's a broken futures contract. You can't look at that. You want to buy a company like Amplats. You want to buy a company that's going to profit from owning more than one spot in the value chain of platinum. Like you want to buy Codelco or in uranium, something like that. I'm not saying you want to buy it. I'm just saying you want to own something that's more vertically integrated. I'm thinking about buying some platinum now, but it's really only a valuation trade. It's undervalued. The old story was, if you're bullish gold, buy silver. If you're bullish silver, buy platinum, because it's more, you're moving. Gold is just precious, silver is precious and industrial, and platinum is almost entirely industrial. So that's my stance on it. I'm waiting for platinum. Here's what I'm waiting for to buy platinum. I'm waiting for platinum to go backwardated. Now, this is a tactical thing. When platinum futures go backwardated, I think the market's going to rip. And until it does, it remains a broken market that will make you buy the highs and sell the lows. In terms of companies, I don't know much about the companies anymore. Maybe Amplats a little bit. What do you think?
Yeah. The 2 that I own in very small size compared to some of the other stuff I have in the portfolio are Sibanye-Stillwater and Impala Platinum. Sibanye is a little bit of a circus as far as the assets they have in other companies, in I think lithium and some other. Basically, it's not clean. It's not a clean balance sheet. Like, there's hair on it. It's in South Africa for most of their operations. But if we do kind of get platinum ripping, then it's the type of thing that could earn its entire market cap like pretty quickly. And I mean, it was a $20 stock a couple of years ago. And Impala is in much better shape as far as the balance sheet. I think it's a little bit more of a pure play on platinum. But I kind of think it's basically something where I can't bring myself to own them in size just because of the country risk. But I think it makes sense to have a small position as basically a call option on what I think platinum will do over the next, call it 3 years, 5 years, and you don't have the time decay. So.
Right. No, I understand. You mentioned nation risk. That's spreading. It's not decreasing. And I'm talking about gold now has overseas or nation risk. If you're operating a gold mine in Africa, you're Newmont, they say, we want you to pay us. We want you to give us some of your gold. We'll pay you spot for it. So, I mean, there's Latin America. You're seeing I think one of the reasons that the Canadian miners, specifically on the gold and silver side, are underperforming is because of that risk in South Africa and South America. So You're definitely dealing with nation state risk. And the reason I stay away from miners, and I'm not anti-miners, I don't know them very well, so I'll just do a GDX or an Amplatz for platinum, or a Newmont for gold. The reason I stay away from them is because I don't know them, and I know how important management is. It really is important. I mean, it's the most uncommoditized commodity out there. I mean, I went to a mining conference one time. This is what turned me off to miners. And I went there as an investor, and, I was courted. And I had these, I sat down with executives of mining companies, and they were just salesmen. They didn't know their business. And I was shocked by the lack of knowledge. And it seemed that a lot of these mining companies, and I don't know about platinum, right? It seems that a lot of these mining companies, they're just basically hiring marketers or influencers to run them. And so the few times that I sat down with one of these executives who brought along his geek, his quant, his geologist, and I asked the geologist questions, he didn't feel comfortable answering me in front of his CEO. And so I walked away, and I went, this is when John Paulson was buying in 2012, around then. Mm-hmm. He was buying all the miners. And I was like, this is crazy. I can't buy it. You have to know your executives in these companies, because look, let's face it, mining in general dropped the ball in the 80s. Oil and miners, regular oil producers, right? Exxon, Chevron, they mismanaged their company during the bull market of the 70s and 80s. Mm-hmm. And so, but the oil companies came out of the 80s in the 90s and got smart and started hedging their production, started hiring people that understood. Miners are still like, using a divining rod to find water, and so if you don't know the management, there's good management out there. There's plenty of cold stoves out there I haven't touched because I've gotten burned by a couple hot ones. You know what I mean?
Yeah.
So like, the management, I trust them. If Impala's more of a pure play, what's the other company you mentioned? The one with the hairy balance sheet?
Sibanye Stillwater. Like, they have some exposure to, I think, uranium tailings. They have a stake, was it DRD Gold? And this is where it shows that, like, the amount of size that I own is not enough to, like, read every line of the fine print. But
right.
I think there's a lot of stuff in Sibanye that you don't have with platinum. And if I just pull up the balance sheet really quick on Impala.
So while you're pulling it up, let me make sure I understand the concept. They need to They need to clean up their balance sheet by getting rid of stuff that's not core.
Either that, or they need to get a nice little run in the platinum price. But if we look at Impala's, so the current portion of long-term debt, so they have $100 million in debt for Impala, and it's a $4 billion company, so that's like not an issue at all. And right. Then Sibanye, I think, has a lot more than that, and I think the maturities are decently far out, where it's like you have at least a couple of years to work with it. But
right,
they're at $2 billion of debt, so definitely more torque if we do get a bull market. But it's not like a clean setup at all. So it's probably, you could argue it's cheaper, but that's kind of do your own research as far as picking those. But right. I think position sizing is your friend on something like that, where like if it works, it's really going to work. If it doesn't, then you could have issues. So
right. You're long a wing call.
Yeah.
You don't need to spend a lot of money to make a decent rate of return if it's right.
Yeah, exactly. But
a lot of people don't understand
that. I agree with you with mining in general. It's a tough business to do well. And so unless you got to have an advantage there to make that work. So I do have a couple questions on kind of the big picture as far as macroeconomics and politics to kind of wrap up.
Sure.
There's been a lot of talk about the SOM rule, a lot of talk about rate cuts, and I've seen lots of chatter about it's automatic that we're getting a rate cut in September, and then we're off to the races. It's going to be rate cuts for next several meetings. Some people are talking about 50 or 75.
Right.
I kind of get not nervous, but when I start to see consensus or kind of that narrative being built that everyone's accepting and getting on the same side of the boat, then I kind of get a little bit antsy looking at something like that. So I'd be curious to hear your thoughts on what might be coming as far as the Fed.
Yeah, I mean, looking at the opinions being voiced, it does seem to be lopsided towards cutting, and the unnerving thing, to put myself in your side of the table for a second, the unnerving thing is how aggressively it ramped up over the last 3 weeks, and there's a logical flow of what happened, and doesn't mean they're going to cut, but you can see, like I could see from the reports that I see, I can see the bubbling up of this. We need to cut. We need to cut. We need to cut. It started with. So the three banks I'm referring to, there's many others, but Goldman, Citibank, and let's say JP Morgan, that was the other one. Those three banks were saying, we think the Fed's going to cut by September. And the Fed had been saying, look, we see the pipeline data as saying a recession is in the pipeline, but we're not going to react to that. We want to see it manifest in the real data. Boom. Which people forget that the opposite of that is what got them in trouble with inflation. They were worried about they looked at the pipeline of data and they said, well, this is going to manifest into that. We better get ahead of the curve and print. So now he's scared to death of reacting to the pipeline. And so now he's waiting, he's solving the last crisis. He's waiting for the data to manifest a recession. So the banks, as is their typical behavior, said, well, we see the recession as inevitable. And the Fed, not paraphrasing, just imagine what he'd say. I don't give a shit until I see the data. I'm not easing. And so I saw that battle for what it was. I saw it as the bank saying, if he doesn't ease, we're going to tell him he's a moron when stocks are lower, and we're going to claim victory. And if there is no recession, Powell's going to say, you're a moron. I told you there was nothing to worry about. So at that point, I was looking at it as just like an ego battle. And then the whole yen carry trade became a thing. And it's almost like those three banks mentioned latched onto it. They had in their pocket the emergency rate cuts need to be done. Citibank, we need 50 basis points followed by 50 basis points. Goldman Sachs went from 1 cut to 7 cuts. And JP Morgan, 75 basis points. And they all had these reports in their drawer. And the yen carry trade seemed like the perfect excuse to pull them out. And you saw the pressure, and then you saw that the professor Jeremy Siegel, it's like he was an employee of one of the banks coming out saying, we need to cut 75 basis points now, an emergency rate cut.
Yeah, he was full meltdown.
Yeah, exactly. And I got swept up in it too. I'm like, oh, you hear it enough, and you start to think, well, maybe he's going to be pressured to cut. Maybe he's going to be pressured to cut. But I also had noticed that Citibank was like the Citibank reports were nothing. And then one day they said, we think the Fed needs to cut 7 times, 25 basis points, 7 times in a row. Boom. And I went, wow, that's aggressive. Let's see if Goldman follows. And they never followed because Goldman said last year, they're going to ease 6 times, and they never did. So Goldman's been burned predicting that. But Citibank's there, and I'm like, wow, they're all by themselves. No other bank is joining them. And then the yen carry trade implodes, and they all start to outdo each other. And I go, all right, these guys, and I'm being cynical about this, is These guys are long. They want to be bailed out by the Fed. They need the Fed to lower rates. So now I'm saying, well, it looks to me that they're going to win because in situations like this, stocks start to crater and the Fed reacts to it. And then nothing happened. And then simultaneously, I read a report by Norio Rubini detailing something that I understood but didn't understand as detailed as he explained. And that was, in general, Powell and Yellen have been at opposite sides, opposite purposes. He's been raising rates to slow inflation, and she's been spending fiscally more than she should, in many people's opinions, aside from the usual stuff, to keep the economy going. So this economy is you heard the phrase fiscal dominance. The fiscal side is running everything. Monetary policy can't even stop the economy now, at least not in areas that need to be stopped. Fed raises rates, Nvidia goes up 5%, that type of shit. But what Rubini says is, he says, and I think the guy's name is Marin, working with him, say that Yellen, instead of borrowing all that money, which is bad enough, right? Borrowing all that money to spend it, we need that money to be borrowed and spent to rebuild the economy. You can argue about what it's spent on, but some of that money needs to be spent. But instead of borrowing this money and spending it on the 10-year bond, right? So borrowing at the 10-year rate, which would drive rates up, which would slow the economy down. See, if she went out and borrowed bonds, if she went out and borrowed money to fix the economy at the 20-year bond, that would drive 20-year rates higher. And driving 20-year rates higher would start a recession, period. And Powell would end up eventually having to lower rates. But she didn't. She took the money and said, instead of borrowing at 20 years, simplifying it, I'm going to borrow it 90 days. And I was like, oh, yeah, she's manipulating the yield curve. And I didn't really think about it, but the bottom line is, by her not borrowing 20 years out, it depressed artificially long-term yields, which makes it less likely for Powell to lower rates. And so we come back full circle or full cycle to the yen carry trade, and it's stabilized. I'm sure there's a lot of shit being hidden there, right? The currency bands, the currency guidelines stayed in place, except for some really esoteric ones that I'm not that familiar with, and the Fed hasn't eased. And so I really think the banks are full of shit, and I think we're going to have a recession. I think that's happening right now, but it's not your typical recession. Yellen hasn't stopped spending. She's spending at the short end of the yield curve. The long bond is too low. If he lowers rates, he's going to I believe he knows that if he lowers rates with her not borrowing at the long end of the curve, then inflation is going to spike even more and the dollar is going to weaken even more. And so I think there's a chance, to your whole asymmetric point, there's a chance that he does not ease unless he absolutely has to, and this election is over. There's a chance. I think you're crazy to think he's going to ease 75 basis points. He doesn't get along with Yellen, They don't get along. So
yeah, there's lots of crosswinds. It kind of seems like he's waiting to see the whites of the eyes, I guess is the saying. But it's interesting to see kind of the stuff, because I kind of follow Tom Longo and his kind of updates on yield curves and all that stuff.
Mm-hmm.
As far as the kind of monkey business around that, do you think that is less useful as far as predicting a recession? Because as soon as it went inverted, everyone's like, all right, start the countdown. It's 6 to 18 months till recession. This has been the longest kind of inversion, I think, in history from what I've seen. But it makes it interesting to think about how useful it is when you have some of the manipulation going on.
Right. Okay. So the yield curve. Yeah. I write a great deal about that stuff. I'm not saying I'm a bond person, but I am a term structure person. So you're an accountant by training. You understand. there's only two things that matter: money and the opportunity cost of money. So it's present and future money value. The yield curve, these are the scientific facts. And I said this when it happened, and I was expecting it to uninvert sooner. When the yield curve inverts, that's almost a metaphysical guarantee of a recession when it uninverts, period, right? So as it's inverted, you're fighting inflation. As it uninverts, you're fighting recession. And I think it's helpful to talk about, look, all these correlation traders out there that are getting their asses handed to them, the dollar's stronger, gold should be down and gold's up. Yields are getting hammered and stocks are up. Like these correlations do not dictate the market. The market dictates the correlations. So when a yield curve inverts, you can make the statement that we'll have a recession in 12 to 18 months because that's the longest the yield curve's ever been inverted. But now we're looking at a 24-month yield curve inversion. I'm not sure what it is, but it's been inverted for so long. It's like, well, where's the recession? Well, the recession comes when the yield curve uninverts. And the yield curve uninverts, wait for it, the yield curve uninverts when they lower the front month rates. And when they lower the Fed funds rates, they lower them because there's a recession. It's a tail dog problem, okay? So people that are looking at a yield curve, they're looking at the inversion, right? So you've got your 5.5% sloping down to 4%, let's say, to simplify it, right? And you say there should be a recession. There will be. People understand. Like the Fed raises rates to stop the movement of money. The Fed raises rates risking recession because it's worried about inflation. And when inflation is under control, they will ease it and hopefully the curve will normalize or re-steepen. If the Fed doesn't lower rates fast enough, if they continue fighting inflation past the time that they should, they risk bigger recession / depression. So I don't think the curve itself is telling you what's going on. And the curve itself is telling you that we're still fighting inflation. And in order to stop, I'm not saying inflation is a problem right now. What I'm saying is inflation, look at the yield curve as a snake, right? And inflation is like this big pig being digested by a python, and it starts at the front end. And as time goes on, for the marketplace to say, we're never going to have inflation again, you need to have long-term rates discount that. You need 20-year rates at 5%, because then we'll say, well, at 5%, then there's some risk in the market. And that keeps the economy from overheating. I'll buy some bonds if I'm worried about it. But when you artificially, as Yellen is doing, keep the long-term yield low, you create a worse steepening than you have, which means inflation never gets to work its way out on the curve. I mean, I'm basically quoting Posar in May. I'm not saying I'm on a first name basis with him, but I had a communication with him on this topic. And the communication was like this. Me asking a question. Where we need the yield curve to uninvert. We need the yield curve to steepen is what I said. And I went through my reasons. And his response was one word: yes. And Powell wants the yield curve in the back months to go up so then he could use yield curve control to stop it. But the point is Yellen's not letting him. So he may end up causing a much deeper recession than we bargained for. But that's because he knows that inflation is not dead yet. So long story short, the yield curve is correct. We will get a recession simultaneously with the yield curve uninverting. And the yield curve will uninvert either by A, Powell lowering rates, or B, Yellen borrowing where she should be borrowing on the yield curve out at 10, 20 years. Long-term rates have to go higher relative to short-term rates. And when that happens, the economy will slow down.
Do you think that takes a new Treasury secretary to get some cooperation there? Or do you think she'll eventually give in on that front?
Oh, she won't give in. She's ideologically driven, and unfortunately, I used to have a lot of respect for her. Not that I'm an important person in this field, but I used to have a lot of respect for her, and I thought that she was actually a competent economist and an idealist. But now I see her more as an ideologue who's not pragmatic at all, and her strings are being pulled by someone else. But paranoia aside, they're not going to reconcile, and I know they're not going to reconcile by how she reacted during the SVB crisis. Her lack of competency scared me, but that's another conversation. So I guess what I'm saying is, will Yellen be replaced? I think we're talking about the president here, right? If Kamala is president, she won't be replaced, or she will be replaced by someone who's similar, right? If Trump wins, she's gone, right? And if Trump wins, picture someone very stingy with spending comes in under Trump. And so Powell can say, I can lower rates now. Even though he doesn't like Trump, he's going to do that. So I think the who is in these positions has become such a political problem. I don't even think Powell's going to be here a year from now. I mean, why would he? He doesn't like Trump. He doesn't get along with Yellen. So.
Yeah, it'll be interesting to watch. I think a lot of things are going to change over the next several months. The last question I kind of had on that front is the whole stagflation setup and some of the stuff with the three-legged stool you mentioned in the talk on Palisades Gold Radio. But I kind of think with where we're at as far as energy prices and the deficits, like you mentioned, it's kind of tough to have like some massive recession, and that's kind of where the stagflation argument comes in. But it's hard to see where things go from here, but I don't see some massive like deflationary bust type setup. So I don't know if you have any thoughts on that.
Yeah, this is an interesting thing. Without the three-legged stool is a nice analogy, but I think there's a better explanation that would answer what your comments or question are. The argument about stagflation versus no stagflation can be summed up by looking at how the economy was before COVID and after COVID, right? So before COVID, talking about the great financial crisis. Before the great financial crisis, the economy was what everyone termed Goldilocks. Now, you had deflationary tailwinds. So every time the Fed was worried about inflation, some innovation came along, simplifying it, but a supply chain innovation came along that drove the price of goods down. And that allowed the Fed to stay easy a little bit more than they should. Not that they should. And
Chinese
so we had
manufacturing, shale oil. I mean, go down the list.
You got it. Exactly. That's perfect. Shale oil and Chinese manufacturing, right? Cheap Chinese manufacturing and cheap oil. Every time the Fed made a mistake and eased too fast, well, the deflationary forces of innovation kept pushing it along. All right. So now, post-COVID, so from great financial crisis to COVID is the dead zone, right? Post-COVID, you have disinflationary tailwinds are now inflationary headwinds, right? All those innovations from supply chains, gone. You've got to, you can't get your stuff from simplifying. You can't get your stuff from China anymore. You have to get it from Canada. You can't get cheap lithium from some poor third world country anymore. You have to get it from Arkansas, which in the United States, sadly, can be viewed as a third world country. Hopefully they're doing well now that the oil companies are drilling there. Hopefully they're benefiting from it. But I mean, the point is, inflationary headwinds that we have now are a result of broken supply chains, increased shortage of a natural resource availability, whether it be oil, whether it be lithium, whether it be copper, and a fracturing of relationships that creates a mercantile approach, a protectionist approach where it's like, we won't buy your cars, you won't buy our, umbrellas. And so taxes start getting put on. And all these things become inflationary headwinds, slowing the economy down. And so what we've done is we're fighting these inflationary headwinds. And part of that is as we retool our supply chains, we're spending a lot of money on infrastructure. I'm not saying it's all going to the right places. Manufacturing. We're throwing money at the Rust Belt and asking chip companies to open up shop there, right? That part of the economy is cooking, right? Now you've got housing until recently also cooking, hot, because people are moving from urban areas to what they see as more safe areas. So that half of the economy is doing really well. The other half of the economy, which is the services or financialization economy, insurance companies, certain insurance companies, financial companies, day traders, that mindset, right? All those people that work in white collar offices, they're getting fired, right? So the stagflation comes from natural resources are going up in price, and we're buying them like there's no tomorrow to build our new factories in Ohio that make chips and make EVs, right? And then the that's the natural resources go up, labor goes up in price. The recessionary forces come from the white collar welfare rolls going up, people getting fired. People aren't going into offices anymore. That means the deli that the office complex ordered from, out of business. The real estate, out of business. All these things that were part of the dynamic 1980s Goldilocks economy are being discarded. So the result is us having conversations like, well, is there a recession or isn't there a recession? Well, it depends on who you ask. Talk to the hairdresser, who has a shop on the same block as a Wall Street bank. Well, there's a recession. Talk to the drywall hanger, in Ohio, or the welder, who can't stop working. And the economy's gone from services to manufacturing, just like it went from manufacturing to services in the 80s. So right now, all the financial people are going, well, it's recession. It's not. It's both. It's what do they call it? It's the K economy. Half the economy is doing fine. The other half is underwater. Those are the two legs of the K. And so if we pull out of it properly, the manufacturing spending bears fruit. The white collar people that are getting unemployed because of AI taking their jobs, right? To simplify it, they learn how to become welders. That's not going to happen, right? Or that's if we do it well, right? If we do it poorly, all the money gets spent on these buildings, and unions end up getting raises. I'm seeing this now. Unions get raises before the building is even started.
We keep throwing money at Intel, stuff like that.
Yeah, keep throwing money. Right, Intel is basically a corporate award of the government.
Yeah.
Right. Exactly. So the answer is if we don't, and I say this optimistically, if we don't have genuine stagflation, I will be surprised. And it will be a triumph of what the Fed is doing and what China is doing behind the scenes to kind of not be our complete enemy. If we do have stagflation, that will be, I would lay that at the feet of the elected politicians, like the Democrats, who are going to spend on, childcare, noble ideas, but do you have the money, or the Republicans that want to spend on a bridge to nowhere, to paraphrase the old
rounds for Ukraine. Yeah.
Right. Exactly. Right. The neocons building tanks for the Ukraine, and the Democrats, throwing money at babysitters to make them have minimum wages. Yeah, exactly. That's it. So we're mortgaging the future to take care of the present with the spending. we need to mortgage the future to take care of the future. And we're not doing that. So that's what I'm worried about. So I think a standard recession would be cool. It would be like, you know what? We're doing all right, but a stagflationary recession means that there's a big problem, I think.
Yeah.
And it could last years.
Especially for certain sectors. But I mean, I could go on for hours and keep kind of peppering you with questions. We didn't even really get into the geopolitical current events, which I think would be an interesting topic. But before I let you go, I wanted to ask kind of one final closing question, which is, what book do you think I should add to my reading list?
Oh, okay. All right. So that's a question you throw at everyone you interview?
Yep.
Or is there a specific topic that you want to...
I throw it out there for everyone. Can be finance, investments, history, anything you think would be interesting.
Okay. I'm in the middle of reading 2 books. I hesitate to share them. I've read all the finance books. I'm not saying that I don't need to read them again, but I've read them all. But there's always something to learn from. I'm reading 2 books. One is The Wager, which is a novel about a ship at sea. They're probably going to make a movie out of it. Really good. Has all those crazy things that the English were doing, like cannibalism. It's a good novel. And the other book is a little bit headier, and it's Totalitarianism by Hannah Arendt. She discusses the fascism, communism, Stalinism from a perspective of someone in the 1940s and 50s. So those are the 2 books that I'm reading. If you want to read them, that's entirely up to you. But that's what I'm reading right now.
That second one's probably pretty timely with where I think we might be headed. So
it caught my eye. Yeah.
Before I let you go, where can anyone listening find you as far as your Substack or anything on Twitter?
Sure. I have a newsletter called the Gold Fix, and it's Gold Fix. It's VBL, Vincent, Victor Boy Larry, goldfix.com or at substack.com. And we send out at least as many as 3 emails a day, but they're not junk. It's very intense. We'll discuss tactical trading like we did today with precious metals. We'll discuss big picture economics like bonds in the UK and what they're doing over there. And we'll also discuss geopolitics, which involves oil and China and the BRICS and what have you. So it's a big umbrella type of thing. But the focus is through the lens of precious metals, right? So there's if I can talk about metals, it's going to be in there. If Yellen goes to the grocery store and I can make it about gold, I will. But that's genuine. So if you go there, you can subscribe for free, or you can subscribe premium, and we do break down copious amounts of professional, institutional grade reports from banks that pretty much no one else does. So that's it.
Yeah, I'm a subscriber. You guys should definitely go take a peek. You might find it interesting. But with that, I think I'll be wrapping up. So thanks for stopping by. We'll see you next time.